Cody Biggs, Valuation in M&A, How to Select the Right Model. As the late business magnate Warren Buffett once said, price is what you pay. Value is what you get. In the world of mergers and acquisitions, M&A, this value-based approach to valuation has certainly stood the test of time, thanks to how it helps process buyers identify potential returns while protecting against downside risk with any particular deal. With so much on the line, selecting a model that accurately assesses both current and future value should be one of your primary areas of focus when looking at M&As, something which can be more easily achieved by having a good understanding of valuation principles. Here, Cody Biggs discusses some different methods for evaluating an acquisition based on their associated risks and rewards in order to ensure that buyers are getting good value for money. Cody Biggs on Valuation in M&A, How to Select the Right Model. Valuation in M&A is an important aspect of the deal process, says Cody Biggs, as it can determine whether a transaction takes place and how much money each party gets. It also affects tax implications, which could have a significant impact on both parties involved. There are several models used to calculate valuation in M&A deals, each with different levels of accuracy and complexity, so it's important to select the right model for your particular situation. The most commonly used models for valuing companies in M&A transactions include discounted cash flow, DCF, analysis, comparable company analysis, CCA, sum of the parts valuation, liquidation value approach, merger arbitrage analysis, and book value methodology. The DCF analysis is a complex model that takes into account the cash flows generated by the target company, as well as its expected growth rate. It's typically used for larger and more mature companies, and it allows you to adjust the inputs, such as the discount rate or terminal value, to see how different values affect the overall valuation. The CCA is slightly simpler than the DCF analysis, and it involves comparing similar companies in your industry to estimate what your company may be worth. It's often used for smaller companies or those with limited financial data available. The sum of the parts approach looks at each business unit individually and adds up their respective valuations to get an overall figure for the entire company. According to Cody Biggs, the liquidation value approach looks at the assets a company has and assigns a liquidation value to each of them, adding up all of these values to get an overall valuation for the business. This model is used for distressed companies or ones with a limited future outlook. Merger arbitrage analysis is similar to the CCA but takes into account any premiums or discounts in stock prices due to market speculation around pending M&A deals. Lastly, the book value methodology looks solely at a company's balance sheet, using historical data and current liabilities to calculate its intrinsic worth. Cody Biggs's concluding thoughts. It's important, as per Cody Biggs, to choose the right model when valuing your company in an M&A deal, as it can have a significant impact on the overall outcome. For example, the amount paid for a company in an acquisition can vary greatly depending on which model is used. According to a recent report by Deloitte, companies that use discounted cash flow analysis typically achieve valuations 20 to 30% higher than those relying solely on book value methodology. When selecting the right model, it's important to consider the complexity and accuracy of the model, as well as whether your company or industry is suited for a particular approach. Thanks for watching.